Ladies and gentlemen.
Good evening.
Are you ready?
Okay, here we go.
You're listening to the Deal Room Podcast. Join us as we bring you the inside scoop on business sales and acquisitions. Get across trends in the area and hear the industry's best recount their real-life tips, traps, and experiences. Now, here's your host, Joanna Oakey.
In this episode of the Deal Room Podcast, we take a quick run through the area of financial due diligence with Luke Malone from Prosperity Advisors. We cover some of the terminology in this space and many of the issues that should be considered on both the buy side and sell side, including timelines, working out the right level of DD, and some interesting stories about skeletons that can be found in the cupboard. All of this and more in this episode of the Deal Room Podcast. Here we go. Hi, it's Joanna Oakey here, and welcome back to the Deal Room Podcast, brought to you by our commercial legal practice, Aspect Legal. Now, today we have on the show Luke Malone from Prosperity Advisors to talk to us about the fascinating area of accounting due diligence. It is fascinating.
It is, absolutely, Joanna. Very exciting stuff.
Yeah, it is. So look, we've spoken on this podcast. You as our listener may recall quite a few times about DD from a legal perspective. But I thought I'd get Luke along today to talk about the accounting and financial perspective, to give us something other than just the legal DD side to focus on and think about. So Luke, welcome on board. Thank you for coming to the Deal Room to talk today.
Thank you very much, Joanna.
Great. Look, I want to start off maybe by giving our discussion a little bit of context. So maybe you can just give us a little brief overview of who you are and who you work with in this space.
Sure, absolutely. And thank you very much for the opportunity to talk to your listeners today. I guess in terms of myself, I've been working as a chartered accountant for the last 20 years, predominant focus in the SME and fast growth businesses area, a lot of entrepreneurial businesses, a lot of businesses looking for growth, acquisitions, potential exit events, but be they through private equity or IPO. So we work very closely with our clients. The clients that we work on are in a variety of industries, but typically range in the sort of 5 million turnover up to a couple of 100 million turnover usually. And I guess we work collaboratively with them to help them navigate that due diligence pathway.
All right, wonderful. Well, look, let's talk about due diligence. So I'd like to just start off with the basics. So let's just start right from the ground up. Mm-hmm. What are you usually looking at when you're conducting your financial accounting due diligence?
Yeah, I guess if we're doing a financial due diligence, Joanna, that is on the, I guess, buy side, as you'd like to call it, we're looking to work closely and collaboratively with our client in looking at that potential target. So I guess we look at a number of things. Obviously, the historical financial information is critical. So getting a good understanding of the EBITDA and the operating metrics of the business, the revenue, the expenditure profile, trying to help determine what the normalised earnings of that business may be over a three-year period, for example.
I think it might be useful for some of our listeners to dig a little bit into this concept of normalised earnings. So maybe can you talk briefly about that as well in terms of what you're doing when you're looking at normalised earnings?
Yeah, sure. I mean, it's usually a key component of the DD, the normalised earnings, because it then drives the multiple and I guess the eventual purchase price that they maybe end up paying for the business. So making sure that those normalised earnings are well looked at and considered is very important. So the normalised earnings themselves is looking to strip out, I guess, transactions that wouldn't be there once the acquirer takes over the business. So that may include things like related party transactions or transactions with existing shareholders, such as their salaries and other fees or arrangements with them if they were not to continue in the business. Or it may include other costs that may not be there going forward. So if we were to be able to, for example, remove a warehouse or a rental property, lease premises that are no longer required post-acquisition, it's those kind of things that we can remove and then give the acquirer a sense of, well, what does the business look like post-acquisition?
How are you identifying each of these areas to strip out? You know, I mean, I can imagine it's quite, some probably are fairly obvious, but I can imagine there's quite a lot of nuance in finding some of the,
Yeah, there certainly is, and I guess it takes I guess an experienced team and good people on the ground to work collaboratively, proactively with the target. So there's a lot of time spent on site with their management and getting I guess under the bonnet in terms of their P&L and how their business operates. So getting a real understanding of what those transactions may be, working with their finance team and their accountants to get a sense of what they are, and then obviously coming up with what we think that normalised earnings should look like.
Okay, great. And sorry, I think I interrupted you when you were running through the other things that you look at when I wanted to talk a bit more about normalised earnings. Are there other, key areas that you're also looking at?
Yeah, absolutely, Joanna. So I guess it's then sort of, as I said, the historical financials are a key aspect to give, I guess, the acquirer a sense of what that business may be able to generate for them in the future, what do future forecasts look like as well, and what about the balance sheet, I guess, in terms of what's on the balance sheet. Are we comfortable with the accounting treatments that have been adopted? Are they in accordance with accounting standards? Are things like their liabilities and whatnot complete? Are there any risk areas or understated, I guess, liabilities, for example, that need to be considered in light of the context? Obviously, that then dovetails into the legal process in terms of understanding, what sort of warranties and things do we need to have in the share sale agreement? Are there any particular risks? And then also feeds into the tax due diligence component of it as well.
Well, that's a really long list there, Luke.
It is.
We know why it sometimes, can take a while for this, a proper due diligence process to be conducted. But as we all know, transactions differ in size and in risk. Sometimes those two elements, size and risk, correlate. Sometimes they don't.
Yes.
But, and there's always this question, I think, let's put our commercial hats on. How do we work out what is the right level of due diligence to be looking at? Certainly from a legal perspective, that's something that we have to be acutely aware of, because there's, to some degree, no end to the amount of legal DD you could do. I'm sure it's the same from a financial perspective. But we always have to sit here and say, well, what's reasonable and required in the circumstances? So how do you go about that process, Luke, of working out, the right fit for each transaction?
Yeah, that's absolutely right, Jonah. I mean, you've got to be commercial and pragmatic about these things. I guess the way that we work and operate in that regard is we work closely with our client who's looking to acquire that particular business and get an understanding of their risk profile and what they'd like to see, but at the same time give them our insights and experience as to what we would recommend in terms of the level of due diligence. I guess a current example, we're working with a large Chinese listed business that's looking to acquire some businesses here in Australia. They need a lot of guidance and help because they're not so sure of the Australian regulatory environment, and they may have a different risk profile to someone that's operating here day to day, for example, and the amount of years of due diligence they want done, again, may be different to someone else that, understands what they're going into a little bit better. So.
Yeah, I think it's a fabulous point you make there, because I think understanding your client is a really important element. But quite often, we have clients that have come from a range of different countries when buying into Australia. And certainly if they've not had experience in the Australian environment, obviously it becomes an environment where you're providing more of an educational function.
Absolutely.
Maybe for organisations that are based here.
Yeah, absolutely.
But it's about picking that level right, I think, because I think that's where, and certainly complaints I hear around in the industry often revolve around the failure of advisors to pick that level right. I mean, lawyers and accountants and other people in the process. So I think that's a really important consideration for advisors to be making.
Yeah, absolutely right. I think, you've got to work very closely with the client to help them understand the risks that they're going into, and then get the level of work that appropriate for them to match their risk profile, as well as obviously the services they need and the fees and their budget, etc. So it's got to be a collaborative approach, working closely with them. There's basics that must be covered on all financial due diligence that you would say are non-negotiable, but there's other parts that you can work around if required.
And budget is an important thing. It's good that you've pointed to that, but I also find timeframes. I'm sure you've been in the situation where you have clients that are wanting a DD process to happen as quickly as possible. Yes. And I guess there's other issues for advisors here, in managing client expectations as well. But finding that fine balance between an appropriate level of investigation into an organisation as well as fitting into the commercial imperative of the deal.
Absolutely, I think that's critical in the process, and time is always a big constraint. Everyone wants their transaction or their deal done quickly and efficiently, and I guess we all work hard to make that happen. But I think the point you raise is a good one. It's sometimes taking that little bit extra time allows for appropriate consideration of risks and make sure that the wrong decision isn't made.
Yeah.
There's plenty of acquisitions that have been rushed and sometimes the outcomes are not great, or that the appropriate level of due diligence wasn't requested or performed.
So tell us, maybe do you have some examples of that, Luke? I love examples. I love to hear.
Yes, there's a couple of good examples in recent times. One was a large dairy business, fairly significant transaction. The business was sort of valued around the $200 million level, and fairly significant operations in manufacturing in Australia. And I guess the client was very keen to proceed, and they decided that they thought that they could handle limited due diligence internally, and they thought they knew the risks. But unfortunately, post that acquisition, they suffered some significant poor financial performance and results in that business post acquisition that was not reflective of what they saw in the information they'd been provided. And I guess they hadn't dug far enough into it to sort of understand it.
And so that's the sort of thing you feel that a proper DD process could have picked up.
Absolutely. So I guess we then got involved and helped them out with trying to unravel some of the problems, and I guess we then identified what some of those problems were that would have been very apparent had we been involved from the beginning and performed a complete due diligence process, which for that business wouldn't have been a huge amount of money. I guess there was just an imperative to get it done quickly at the time, but if they had stopped, paused and spent a little bit of money, I think they would have saved themselves a lot of the hassle that they subsequently had.
Yeah, and I think a lot of the issues can occur from number one, I think in reality, emotion. Like sometimes there's been a long search, sometimes it just seems like the right deal is there, and all sensible consideration goes out the window. But I guess the DD process, number one, it doesn't necessarily have to take a massive period of time. Obviously, it depends on the circumstances of the business. But what are some examples, I guess, of how we can speed up that DD process? Are there any things that you can think of that can, provide a situation where we can get through it quicker?
Yeah, I think a lot of it comes down to working collaboratively with the target and helping them identify ways that we can get the information quickly, depending on the size of the target and the sophistication and the maturity of their finance function. It varies. So sometimes you'll have very good processes and ability to get financial information quickly. Other times it's more difficult, and I guess that's where our team likes to get involved and sort of walk the target through the process, spend time on site with them, and sort of drive through that process to help them. Because quite often they're resource constrained, and they've got to continue to run their business. So it's about us sort of working collaboratively and sort of fast tracking that information process, and often getting in there, getting access to their systems, and just drawing that information out that we need ourselves.
Yeah, absolutely. And I think the interesting thing about DD, and perhaps it relates to the example you were talking about before with your dairy business, I see a lot the DD process then potentially being used for redriving discussion about purchase price, but I guess that's the reality. When you are in there looking at the business, it's not necessarily about, yes, we do the deal, no, we don't do the deal. It can also be about, well, is the pricing right now that we're looking at the bones of the business?
Absolutely. So usually a key component of the financial due diligence process is sort of working out, as I said at the beginning, what's that normalised earnings, what's the recurring EBITDA. The existing owners of the business may have a particular view. Once we've completed our procedures, we may have a different view, and that could be because accounting treatments and other things are not followed how they should be, or that there's particular transactions that need to be normalised out, as I said before, so that we can help the acquirer work out, okay, well, what is the true recurring earnings and true EBITDA of the business? And then I guess we can then also work with them to sort of understand what an appropriate multiple in the industry is, so that they can then work out, okay, well, what's this business really worth?
And I mean, that's a fascinating topic in and of itself, the appropriate multiple to be using. And there's a lot of discussion around about the difficulty of picking, appropriate multiples. And of course, multiples are useful to a degree, but at the end of the day, a price is, just what the market will bear at the point. So, multiples can change widely over time and depending on the business. But, what sort of issues do you see with business owners coming in with an idea of a multiple that they think is applicable? And how are you finding the multiples to use as comparisons, I guess?
Yeah, look, I guess it varies. So some business owners will come to us with sensible multiples and understand where they sit in their particular industry. Others have got more lofty aspirations and believe that they may have a higher value, and that could be driven for a particular reason. And we also have, I guess, acquirees that are willing to pay a higher multiple for particular strategic reasons. So, it's not, as you say, it's not always just the multiple, and it can be different for different reasons if there's a strategic fit for a particular target. I guess how we go about looking at that, I guess we've got access to our valuation specialists. We've also got access to, I guess, market transactions and databases that we look at in terms of particular industries and research that we can share with our clients in terms of, okay, well, this is what this particular, in this industry at the moment, these are sort of the businesses that have been sold. These are the multiples that are being generated. And obviously there's a lot of publicly available information, but we also have access to stuff that's not necessarily publicly available.
Mm-hmm. Do you have many instances where you go through the DD process and then you use that to help reevaluate price?
Yeah, quite often. We did a transaction, I think it was last year, with a private equity firm, helping, I guess, the existing owners of that particular large restaurant business to work out what the multiple should be to exit. And I guess we came up with a number of, I guess, examples of recent transactions and other information to help them sort of support that process. Other clients will ask for a full-blown valuation to be performed to sort of work out what the true valuation from a valuer's perspective of the business might be as well. So it varies.
Yeah. All right. Well, then if we swap around briefly, we've been talking a lot about DD from the side of acting for the acquirer. But if we look at, sort of stepping in the seller's shoes here, they're staring down the barrel of a buyer wanting to go through a DD process. What can they do to put themselves in the best shape? Obviously the aim of the game is for the DD process process to not reveal too many holes in the business, right? So, but how do they put themselves in the place of, number one, going through the DD process and having an outcome where the buyer still continues with the transaction, doesn't try to drive down the price, and number two, making it easy from a timeline perspective?
Yeah, I think if on the vendor due diligence side, I mean, we act for a lot of businesses that are looking to sell, and quite often that can be through a variety of paths, trade sale, private equity, or even an IPO or listing. So I guess the key advice is start early. Think about it 2 to 3 to 4 years away, if possible. That's not always possible, but particularly if you're going to go down an IPO path, you need to start to prepare the business a fair way out to make sure that, the financials are presented in the best possible light. So quite often in our role, I mean, I'm also an audit partner as well, and we're working closely with businesses that are preparing to go down that exit path. So we're often looking to work with them and advise them on how to present their financials in the best possible light, accrete maximum shareholder value on exit, and a lot of that is around how do we drive EBITDA north, how do we make sure that accounting treatments and everything else are complied with, and then obviously from a vendor due diligence side, we're looking to put together something for a potential investor or buyer of the business that presents that business in the best possible light. So it's about making sure that there's no hidden skeletons in the closet, so to speak, and how do we help management and the board sort of iron those out so that when DD is done, we've done a lot of the heavy lifting already for the acquirer insofar as, yes, they'll certainly send in their own people to do DD, but a lot of you would hope that 90%, 95% of the questions are answered.
Okay, and then what sort of timeline should, and I guess this is relevant to both sides of the transaction, but what sort of timeline from your perspective are realistic for the parties to set aside for DD? Assuming that they're in the position where they want to move as, quickly as possible, but not urgently, as sometimes happens.
Yeah, look, I guess a transaction window, it varies, I guess, typically based on size, but not always. That's not always the main driver. But I've had DD processes where we're helping a client, sell their business, and it can take a few months or a month or two. Others can take a longer period of time. But I guess in terms of the DD and financial DD process, quite often, and vendor DD process, quite often for us, that could be anywhere as short as a week or 2 weeks up to a number of months. So again, it really does depend on the size of the business and what they're looking to do. Obviously, an IPO is very different to a trade sale to private equity.
Jumping back to the examples here, as I said before, I just love the stories. What sort of things have you found? Like, are there any notable things that you recall finding during a DD process that were, very surprising? Anything that, really stood out in your years of this sort of work?
Yeah, I mean, you always uncover some skeletons in the closet, I guess.
We want to hear the biggest.
I mean, I think it's probably things like where, not particularly sexy or exciting, but, you might be looking at provisions, for example, that are really understated in a particular area. Like I can think of an example where a client had a large rehabilitation provision that hadn't been recognised. They needed to make good some assets at the end of an agreement, and that was in the millions of dollars. They'd kept it off the balance sheet, and that significantly impacted the purchase price and what was going to happen. Other examples have come out in the tax due diligence process where there's problems with the ATO in terms of tax obligations and whatnot, and of a material nature that ultimately led to legal action. So those sort of things that come out.
Things you want to pick up before you're sitting in the driver's seat of that business. Right?
Absolutely, and which is what ties into your process with the legal due diligence and making sure that we've got the appropriate safeguards in place.
Absolutely. All right, wonderful, Luke. Well, look, I think that we've covered quite a bit of territory today. I love some of those stories.
Thank you, Joanna.
Thank you so much for coming on the show. Now, look, if our listeners want to get in contact with you, how do we do that?
Yeah, look, I guess they can contact me at obviously at Prosperity Advisors. Be able to look up the website.
And we'll put a link through in our show notes, just in case you're running along right now listening to this. You can pop into the show notes and see how you can contact Luke.
Yeah, that'd be great. And look, I'm happy to help anyone talk through due diligence process and, how we can work collaboratively with any of your listeners, Joanna, and, particularly on the M&A side where, there might be people out there that have got potential businesses that are looking to merge with others or to sell or vice versa, find a target. So I'm happy to talk to any of your listeners.
Great, wonderful. Okay, well, look, Luke, thank you so much for your time. It's been really interesting talking about this area. I know due diligence on the face of it from an accounting perspective may not sound exciting, but you've certainly made it very interesting for us with all your stories. Good work. Thanks, Luke.
Great. Thank you very much.
Well, that concludes today's overview of the basic concepts in financial due diligence in the context of business sales and acquisitions transactions with our guest Luke Malone of Prosperity Advisors. Now, due diligence is obviously a very important component of an acquisition, but hopefully today we've given you a bit to think about in terms of the considerations about working out the appropriate level of DD, both on the basis of the commercial realities of a deal balanced with the risk profile of the buyer and the transaction. As always, it continues to be the case that using advisors in a sale process who understand what they're doing is fundamental to helping strike that right balance, both in keeping tight on timeframes and providing the right level needed without going overboard. Well, look, if you were interested in learning more about this topic, then you can reach out to Luke and his team at Prosperity Advisors by checking out our show notes at www.thedealroompodcast.com. There we'll link you through to Prosperity Advisors' website, and you'll also find a full transcript of this podcast episode if you'd like to read it in more detail. And of course, if you are a business or you work with businesses who would like to have a chat about determining the right level of legal DD for a potential acquisition or in gearing up for a sale, our team of legal eagles would be only too happy to have a free chat about an appropriate and commercial approach from the legal perspective. Just pop over to our website at www.aspectlegal.com.au, and there you can have access to a calendar where you can book in a time to speak to either me or one of our other legal eagles as part of Aspect Legal. Well, that's it for today. Hopefully you enjoyed what you heard. If you did, please subscribe to the Deal Room podcast on iTunes or your other favourite podcast player to get notifications straight to your phone whenever a new episode is out. Well, thanks again for listening in. This has been Joanna Oakey and the Deal Room Podcast, a podcast proudly brought to you by our commercial legal practice, Aspect Legal. See you next time. Aspect Legal has a number of great services that help businesses prepare for a sale or acquisition, to help them prepare in advance and to get transaction ready. We've also got a range of services to help guide businesses through the sale and acquisitions process. We work with clients both big and small and have different types of services depending on size and complexity. We provide a free consultation to discuss your proposed sale or acquisition. So see our show notes on how to book a time to speak with us, or head over to our website at aspectlegal.com.au.
Ladies and gentlemen.
That will conclude this evening's entertainment.
Thanks for listening to the Deal Room Podcast. To find out more about this episode and other episodes in the series, check out the show notes or head over to our website at thedealroompodcast.com.au.